The siren song of missing out. It whispers promises of untold riches, of opportunities slipping through your fingers like grains of sand. We feel it every day, don't we? That nagging sensation that everyone else is on the cusp of something extraordinary while we're stuck on the shore. In the world of investing, this primal fear, this fear of missing out, or FOMO, isn't just a fleeting emotion. It's a powerful current that can sweep even the most rational investor off course, hijacking our carefully crafted strategies and leading us toward treacherous waters. Benjamin Graham, the father of value investing, once observed that an investor's chief problem is likely to be his own behavior. He couldn't have known the digital age would amplify this truth, but his words resonate profoundly today. FOMO is the ultimate behavioral adversary, a master manipulator that preys on our deepest insecurities. It whispers doubts, fuels impatience, and convinces us that the next big thing is just around the corner if only we act now. This relentless pressure often forces us to abandon our own well-researched plans in favor of chasing fleeting trends, a path Benjamin Graham himself would likely caution against. This relentless urge to keep up, to not be left behind, is fueled by a complex interplay of cognitive biases. These aren't minor glitches, they are fundamental distortions in our thinking that FOMO weaponizes. They can turn a sound investment thesis into a reckless gamble, a disciplined approach into a chaotic scramble. Today, we're going to shine a light on 5 of these insidious behavioral biases, revealing how they are amplified by FOMO and, more importantly, how they systematically undermine even the most robust investment strategies. We will deconstruct how this fear erodes our ability to critically analyze data, to stick to our principles, and to build the sustainable wealth we so earnestly desire. By understanding these hidden mechanisms, we can begin to disarm FOMO, transforming it from a destructive force into a catalyst for even more disciplined and informed decision-making. Let's begin by dissecting the first of these potent biases, the anchoring trap. Imagine you witness a stock surge, perhaps in a sector everyone is talking about. That initial, rapid ascent becomes an irresistible anchor in your mind. Even as the market evolves, as fundamentals shift, your perception remains tethered to that early, exhilarating price. This is anchoring bias, amplified by FOMO. It's the insidious belief that what happened yesterday, that exciting price jump, is the primary determinant of value today. Think back to the post-dot-com bubble era. Many tech stocks, even those with shaky business models and no clear path to profitability, were caught in this trap. Their spectacular early gains became an unshakable anchor. Investors, spurred by FOMO, continued to pour money into these companies, desperately trying to recapture that initial magic, ignoring the stark reality that the underlying business hadn't fundamentally changed, or worse, was deteriorating. The price had become detached from intrinsic value, yet the anchor held firm. The myth that if it's gone up this much, it must keep going up is the siren song of the anchored investor. This thinking completely bypasses the critical analysis of current fundamentals, the competitive landscape, and the broader economic realities. FOMO whispers that past performance is a guarantee of future success, blinding us to the fact that yesterday's rocket fuel, if not replenished by solid earnings and growth, will eventually run out. To counter this, we must implement a valuation reset strategy. Before you even consider investing in a trending asset, force yourself to perform a fresh, independent valuation. Strip away the noise of its recent price trajectory and focus on the fundamental value. This is where Benjamin Graham's principle of the margin of safety becomes your shield. It's that buffer, that discount to intrinsic value, that protects you when your anchor proves to be stuck in the wrong place. Think of FOMO's anchor as a ship's anchor dropped in a storm. It prevents movement. It traps you in place. While you're stuck, the market, with all its shifting currents and tides, sails past, or worse, you might find yourself sinking with a vessel whose true worth you failed to reassess. Next, we confront the herding instinct, a primal human drive to conform, to belong, and to follow the group. In investing, this instinct is particularly dangerous when it's supercharged by FOMO. Seeing a crowd of people seemingly profiting from a particular stock or trend can trigger an overwhelming urge to join in, to be part of the winning collective, lest we miss out on a shared windfall. The meme stock phenomenon, with instances like GameStop, serves as a stark, recent case study. Here, FOMO didn't just encourage individual action, it created a powerful herding mentality. Millions, driven by a shared fear of missing out on unprecedented gains, flocked to these assets. The collective enthusiasm, amplified by social media, propelled prices to stratospheric levels, utterly detached from any fundamental economic reality. Those who joined late, caught in the herd's momentum, faced devastating losses when the tide inevitably turned. The hidden risk in this herding behavior is profound. It often bypasses the very bedrock of sound investing, due diligence. When you're swept up in the collective frenzy, when FOMO screams louder than your own judgment, the inclination to critically analyze a company's financials, its competitive moat, or its management quality simply evaporates. You assume the crowd, in its sheer numbers, must be right. You trust the herd over your own independent assessment. To navigate this, cultivate your independent investor's compass. Before you even consider jumping onto a trending bandwagon, ask yourself a crucial question. Would I still invest in this asset if no one else was talking about it? What is my independent thesis for owning this? This internal dialogue forces you to confront whether your conviction is based on genuine analysis or simply the gravitational pull of the crowd. Following the herd, driven by FOMO, is akin to blindly walking off a cliff because everyone else is doing it. You assume there must be a safe landing on the other side, a shared fortune awaiting. But without checking for yourself, without your own compass, you risk discovering that the collective path leads only to a precipice. Loss aversion. It's that gut-wrenching feeling when you see an investment decline, the intense psychological pain of realizing a loss. This aversion often paralyzes us, making us cling to losing positions, hoping against hope for a recovery. But here's where FOMO adds a particularly cruel twist, creating a double whammy. While we are frozen by the fear of realizing a loss on one investment, the fear of missing out on another, rapidly appreciating asset compels us to act impulsively. Consider this scenario. An investor holds a stock that's steadily declining. The pain of the unrealized loss is significant, so they delay selling, clinging to the hope that it will rebound. Yet, at the same time, they see another asset, perhaps a hot new technology or a trending commodity, soaring upwards. FOMO kicks in, whispering that this is the next big opportunity, the one they must get in on. The result, they often buy that soaring asset at its peak, just as the herd arrives, while still holding onto their original loser. This is a classic double mistake, born from the conflicting fears of loss and missing out. The hidden truth here is that loss aversion makes us oddly risk-averse when it comes to crystallizing a loss, yet paradoxically risk-seeking when FOMO drives us toward potential gains. This creates a dangerous asymmetry in our decision-making. We become overly cautious about cutting a small loss, only to become recklessly eager to chase a perceived massive gain, often without proper analysis. To counteract this destructive dance, we must implement a predefined exit strategy for every single investment. Before you commit capital, set clear profit targets and, crucially, stop-loss levels. These predetermined points act as an emotional circuit breaker, detaching your future decisions from the immediate, gut-wrenching reactions to price movements. By having these boundaries in place, you neutralize the impulse to sell a winning position too early out of fear, or to buy a surging asset at its zenith simply because FOMO is dictating your actions. Loss aversion, in essence, is like trying to hold onto sinking sand. The harder you grip, the faster it slips through your fingers. FOMO then tempts you with a mirage of solid ground elsewhere, a shimmering opportunity in the distance. But without a clear plan, without those predefined boundaries, you risk finding yourself in the same precarious position. No matter which way you turn, our next adversary is confirmation bias, a psychological tendency that acts as a loyal, albeit destructive, companion to FOMO. Once FOMO has nudged you into an investment, confirmation bias steps in to reinforce a decision. It's our innate inclination to actively seek out, interpret, and remember information that aligns with our existing beliefs, essentially creating an echo chamber for our own convictions. Imagine this: driven by FOMO, you've invested in a stock that's currently experiencing a surge in popularity. What do you do next? Often, you'll find yourself instinctively drawn to positive news articles, analyst upgrades, or enthusiastic posts on social media that praise your chosen investment. You'll highlight these validating tidbits while subtly, or perhaps unconsciously, downplaying or entirely ignoring any negative indicators, any dissenting opinions, or any inherent risks associated with the stock. The danger here is profound. This selective consumption of information doesn't lead to objective re-evaluation. It solidifies the initial, potentially flawed, FOMO-driven decision. You become trapped in a feedback loop where every piece of confirming evidence strengthens your resolve, making it increasingly difficult to step back and assess the investment with a clear, unbiased mind. This can lead to prolonged exposure to bad investments, as you're constantly finding reasons to believe you're right, even when the data suggests otherwise. To combat this, we must practice active disconfirmation. This means deliberately seeking out credible counter-arguments for every piece of information that supports your investment thesis. For every positive article you read, force yourself to find a critical analysis. For every bullish social media post, seek out bearish perspectives. This disciplined approach builds intellectual resilience, helping you to see the investment from multiple angles and protecting you from the seductive allure of confirmation that FOMO so readily provides. Confirmation bias, in the grip of FOMO, is like a detective who, having settled on a suspect far too early, then dedicates their entire investigation to finding clues that solely implicate that individual. They will meticulously gather evidence pointing towards their chosen suspect, while conveniently overlooking or actively dismissing any information that suggests innocence or points to an entirely different perpetrator. This tunnel vision, fueled by a desire to be right can lead to the wrong conclusions, and in investing, the wrong conclusions can be incredibly costly. Finally, we arrive at overconfidence and the illusion of control, perhaps FOMO's most potent and deceptive trick. When we chase fleeting trends, fueled by that persistent fear of missing out, we often develop a dangerous misconception. We start to believe we possess some sort of superior insight, a hot tip that others lack, or that our entry points, driven by FOMO, are actually acts of strategic genius. This fosters a false sense of control over the inherently unpredictable nature of markets. Consider the trader who has, by chance or early timing, caught a few significant moves in a volatile market. The thrill of those quick wins, coupled with the FOMO that likely drove them into those trades, can create a potent cocktail of overconfidence. They might start to believe they can perfectly time the market, that their gut feelings are infallible, and that the underlying randomness of market fluctuations is somehow under their command. They ignore the fact that luck, not skill, might have been the primary driver of their early successes. The systemic risk overlooked by this overconfidence is the market's inherent unpredictability. When we believe we have control, we become blind to the true nature of risk. We underestimate the possibility of sharp reversals, unexpected news, or simply the market correcting itself. This makes us incredibly susceptible to large, devastating drawdowns when the trend we were so confidently riding inevitably reverses, often with little warning. The antidote to this deception is to cultivate radical humility and data discipline. This means regularly reviewing your past investment decisions, not just the winners, but critically examining the losers and understanding why they went wrong. It means prioritizing objective, data-driven analysis over fleeting gut feelings or the intoxicating thrill of chasing trends. Focus on the discipline of your process, on the quality of your research and decision-making framework, rather than solely on the immediate outcomes. Overconfidence, when fueled by FOMO, is like a gambler who, after a few fortunate wins, begins to believe they've mastered the game. They feel invincible, in control, but then they face the house's statistical edge, that unyielding mathematical certainty, with their entire bankroll. This is the ultimate illusion of control, believing you can outsmart the odds, only to discover the power of probabilities and the inherent randomness you so confidently ignored. We've journeyed through the often treacherous landscape of investment psychology, dissecting how the pervasive fear of missing out, or FOMO, can dismantle even the most meticulously crafted strategies. We've seen how it weaponizes biases like anchoring, leading us to fixate on past glories rather than present realities. We've explored the herding instinct, where the allure of the crowd drowns out our own critical analysis, and how loss aversion, when combined with FOMO, creates a dangerous double bind, paralyzing us in losing positions while driving us to chase peaks. We've also uncovered confirmation bias, which builds an echo chamber around our FOMO-fueled decisions, and the ultimate deception of overconfidence and the illusion of control, where perceived market timing becomes a substitute for rigorous data. The core message, echoing through each of these biases, is simple yet profound. FOMO is not a signal to invest. It is, instead, a critical warning sign. It's the internal alarm bell that tells you to pause, to step back from the emotional fray, and to engage your analytical mind. It's the moment to ask yourself not what am I missing, but what is the data telling me? Warren Buffett, in his timeless wisdom, reminds us it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This principle is our guiding light when confronting FOMO. The wonderful allure of a trending, potentially overvalued asset, driven by the fear of missing out, is often a mirage. True value, true sustainable wealth, lies in prioritizing a sound strategy and a thorough, independent valuation, even if it means entering a trade that doesn't have the immediate excitement of a FOMO-driven frenzy. So, I encourage you, as you navigate your investment journey, to actively implement the strategies we've discussed. Employ your valuation reset to break free from anchoring. Trust your independent investor's compass to resist the siren song of the herd. Implement your predefined exit strategy to neutralize the double whammy of loss aversion and FOMO. Practice active disconfirmation to shatter the echo chamber of confirmation bias. And above all, embrace radical humility and data discipline to combat overconfidence. By doing so, you build not just a portfolio, but a fortress of resilience against the psychological pitfalls that so often derail financial success. True wealth is not built on the fleeting excitement of what might be missed, but on the solid foundation of disciplined, data-driven decision-making. Master your psychology, and you will be well on your way to mastering your portfolio.